This is your Wall Street wake-up call. It'll be a big week for earnings. Let's get straight to Maximilian Kunkel now. He's a cross-asset strategist with UBS Wealth Management, joining us from Zurich, Switzerland. So, Maximilian, it's nice to see you. Earnings for the third quarter are set to decline by 1.8% year over year. That's according to FactSet. Do you see that forecast actually coming to fruition by the end of the season?
No, we don't think so. We actually think that earnings are going to be better than that particular forecast. So for the whole year, we're still estimating about 3% earnings growth, and you should also see something relatively similar in this particular quarter, year on year, largely due to, on the one hand, the element US dollar strength, and as well as the other element, some weakness in tech earnings should reverse in this particular quarter.
And are we also starting to see the negative impacts from the energy sector subside?
Yeah, we don't think you will just yet see that reflected in this particular quarter, but much rather in the fourth quarter, which should lead to much stronger earnings growth year on year, particularly in the fourth quarter.
All right, so now that the fact we're seeing earnings growth, at least in your view, that should necessarily be good for the stock market, right? I mean, do you think the stock market will actually pay attention to earnings season this time around?
Absolutely, absolutely. We continue to think just that, actually, because one of the main theses behind our overall stance, which is one of being overweight US equities against high-grade bonds, is just that, an improvement in earnings, which should also lead the market to continue to focus on fundamentals, actually, and therefore lead stock prices higher in the United States. Yeah.
Now we're at about 2130 in the S&P 500. Where do you see the index going, say, by the end of the year?
So on a 6-month horizon, where we have a specific forecast, we see it at 2,250.
All right, and let's shift and talk about the European Central Bank. Obviously, we have a meeting on Thursday. Are you expecting more stimulus measures to be announced, or at least more clarity on a report a few weeks ago saying that the ECB might be looking to taper its bond buying program? I mean, it seems to be getting conflicting reports here.
Absolutely. So we don't see anything happening just yet, actually. If at all, then probably we're going to have to wait until December to get more clarity on what the ECB is going to do. Our base case is that they're at least going to extend by another 6 months, and most likely also continue with the purchase element of around 80 billion per month. Could be a little bit lower, but definitely still around this 80 billion.
And perhaps more clarity on how negative interest rates are impacting the European banking sector, which is, of course, has been facing some headwinds lately.
Absolutely. There potentially a little bit more clarity, but frankly speaking, what we have to look out for now is the statements that come out of the European banking sector and their respective earnings calls. And there we also get much more clarity rather than just from the ECB.
All right, Maximilian Kunkel from UBS Wealth Management in Zurich. Thank you very much for joining us.
Thank you.
I'm Scott Gamm, and you're watching The Street.